Hey, what's up, guys? Welcome back. I wanted to talk about a topic today that is keeping everyone up at night. I mean, it's causing cold sweats, it's making you take long, hot, warm showers. You gotta get it off of your chest. I mean, I'm talking about insurance and mortgage premiums, and it's not that important. I'm just talking about mortgages. What is in a mortgage? And really, it's not that important in the grand scheme of things to know until you're actually on the closing table and you're staring at a stack of closing documents and you have no idea what's in there. So knowing exactly what you're looking at going in before you actually go into that situation is probably a good thing. So I want to go and take the time and just break a couple things down. Now I'm going to go into what I call my home buyer's guide. It's actually a free guide that I just give out to anyone. I'm going to leave a link in the description below, so you guys can download it, take a look at it at your leisure. I'm not going to go through all of the topics and discussions on there because it's kind of long. I'm going to just focus in on the parts that we're talking about today with in regards to mortgage premiums and such. So let's go ahead and take a look. I'm going to go ahead and open up my screen. All right, now here is my lovely buyer's guide. You can see my picture there. You can take your time, and when you download this, you can go through this at your leisure. I think it's pretty cool. You can take your time and read about me if you want. There's your boy. Any case, so those are my preferred lenders that I rock with all the time. I absolutely love them. If you're in the Gainesville area, look them up. Let me go back up to just so you can see a screenshot of that. There you go. Any case, this is what we're talking about today. What's in a mortgage? Really, there's four main portions of a mortgage. Of course, some people probably already know this from maybe experience. Maybe they're already purchased a home, or if you're a first-time home buyer, maybe you have a friend or your parents that have done this, so you might have an idea. Four portions of the mortgage. The principal is the main one. That's the portion of the amount that's borrowed. Of course, then it's the nice interest, and that's the part that the bank wants. They want that because that's how they get paid. Over the length of a 15 or 30 year fixed rate or FHA loan, that's how they're going to make their money. So of course, the lower interest that you can get is the better. We know that in this time we're looking at maybe about currently, and it fluctuates day to day, maybe about 6% right now on average, which is still lower than the national average. And I know that's such a buzzword right now that people are thinking, my gosh, I can't do this interest rate thing. And really, when you look at it, I mean, people in the 80s, 90s were paying like 9 to 10%. So this is horrible. And to be honest with you, you're probably going to be facing less competition if you want to buy now. So it might be still a good time. There's definitely tools that lenders have and realtors have in their tool belt that can actually go ahead and help with things like that. So I don't think you should be really that concerned if you're really in the market to buy. So in any case, let's get back into it. So then there's property taxes, and that's determined by your municipality or the county that your home is located in. If you're like us in Gainesville, you're probably going to get hit up with higher taxes because the university doesn't pay anything, neither does this Shands Hospital. They love to siphon off those extra bills to us, the homeowners, because they're tax exempt. That's how it works. In any case, and that's probably how it's going to work in most like college towns, to be honest with you. But Gainesville is much more than that, which we'll cover in other videos. I'm going to show you a lot more about what Gainesville is about. But let's get back on topic. So the insurance portion, and that includes your homeowner's insurance, or you're going to have your PMI or MIP, which I'll discuss later on in the video. I actually forgot to mention the portions in the video, but we'll get into it. So here we go. So these are the type of mortgage, and this is not an exhaustive list. You can have your conventional loan, FHA loan, VA, and USDA. If you can qualify for those bottom two, hats off to you, and thank you for all veterans, because you guys absolutely deserve every help you can get. So those are two really good type of loan types. If you live in an area and there are USDA, you can search this on Google. You can put in the USDA loan map, and it'll show you the areas that actually qualify for that loan. So if you're in an area that can qualify for that, I would definitely talk to your lender about seeing if you can qualify. So here's just a brief chart, and I simply just go through This is down payment on each type of loan. VA and USA don't have a down payment requirement, which this is a portion I didn't know before I got into this business. Was conventional loans, you can actually put down as low as 3% and still qualify for a conventional loan. You don't need to do 20%. However, if you don't do 20%, see this column where it says mortgage insurance, you will get insurance added, and it's either PMI or MIP, and I'll discuss later. I'm gonna go into another sheet that kind of breaks down what each is, the benefits and cons of each. So then you have FHA. So the FHA loan, of course, you can put down as low as 3.5, but you can also go all the way up to 20%. Also didn't know that. Maybe a lot of people didn't either. You can go up to 20% and still have FHA. So the insurance, depending on how much you put down, it can be as low as 11 years, or it can last the life of the loan. And if you don't put down 20%, so like for instance, on a $300,000 loan, 20% of that would be $60,000. So if you don't put down that, let's just say if you put down 10%, then 10 or above, you can get this mortgage insurance removed after 11 years. If not, you're going to have to refinance after you get to that equity amount mark, which is 20% of the loan amount. So going back to that example, if you have a $300,000 loan, you want to get to at least like 20% of that, just the loan to value, 240,000. So you don't have to pay all the way down to that. Usually your home is going to appreciate in value, and once you have that much equity into the home, then you can refinance and get out of that. So that's just brief. I'm going to go into a little sheet here that's going to show you a little bit more about that. So here it is, the mortgage insurance premium versus private insurance premium. And what is that? So I'm not going to read all this, so don't be scared. I'm going to just highlight a couple key points about each. So what's the pros and cons of PMI, or private mortgage insurance? Usually PMI is associated with conventional loans. So if you put down less than the 20%, they're going to attach what they call PMI. Now it can be more affordable for borrowers with higher credit scores or higher down payments. If you do the conventional loan route, and of course you have good credit, different things, then that could appeal to you. It gets removed after you get to the 20% equity mark, like we just discussed, and there's no upfront premium. The cons, it can be difficult to qualify for because it's not as flexible as FHA, and it can be more expensive for people with lower or working. I feel like it's derogatory to talk about people having low credit scores. It's like, come on, we're working on it. Like, the credit score doesn't determine the person you are. It just means that there was a period of time when we messed up a little bit. We messed up. So we're going through it. So here we go. So what's MIP? Well, MIP is associated with FHA loans. Now this is some that usually you can't get off. This doesn't fall off your loan unless, here it's going to go through it here. A couple of things. So we know that we can put down as low as 3.5. It's good for first-time home buyers or people with lower income or lower credit scores. I like to say more progressive, not low, but in any case, it may be more affordable for people that have more progressive credit scores. We'll stick with that. And of course, but unfortunately, the cons is that you'll pay an upfront and annual premium, which is the UFMIP at the beginning and then annual MIP. You can't remove MIP unless you have a down payment of 10% or more. You'll either have to refinance when you get out of that, like that once you reach the 20% equity, and then, or of course it can fall off if you put on 10%. So that's the kind of the key things I wanted to discuss in the mortgage. I kind of went kind of quickly there, but like I said, you can download the home buyer's guide and kind of go through it in more detail at your pace. But one thing I wanted to do was use our trusty tool here that people love to use and realtors hate, is Zillow. I wanted to just go over this because I kind of wanted to give you a live example of what it looks like. What does affordability look like? What does it look like when you tweak the numbers, you put down a little bit more? And these are are calculators that are available online. You can search for them, but I think I always like to see a visual. I'm a visual person, so I'm gonna just go in Gainesville because that's where I am. And if I'm typing Gainesville right, I did not spell it correctly, but whatever. So let's take a look, and I'm just gonna pull up a house, just any house in Gainesville. Let's just look at a nice bomb house here. Let's set the price at. Typically, I work with a lot of buyers that, they're starting out. Maybe their house is not as much, like maximum 350. All right, let's see. I'm just gonna grab any house that looks kind of cool. That one's pretty good. Okay, let's just say this one's pretty nice. Take a quick look at it. Okay. All right. It looks good. It looks good. I like that deck. So anxious when I hear to browse, even though this is my pastime. I'm gonna take this address. I'm gonna use my tool here, and the reason why I'm doing this is just to show you guys an example of affordability. All right, so this thing, my tool here is gonna calculate. It's gonna ask us no questions. So what's cool about this is gonna bring up the estimated annual property tax. So a lot of times, and let me go back very quickly. What Zillow's not telling you, because it'll tell you things like, oh, we think the mortgage is gonna be this, but it's not bringing into account. So this is trying to estimate the monthly cost, but it's not bringing all these other factors such as what do you qualify for? What's your, it doesn't know you. It's just saying this is typically the ideal person that it's trying to bring up. Doesn't put LIP in here, no mortgage insurance, because it doesn't know what type of loan you have. It's putting the property tax. It's just trying to estimate. It's just like I said, Zillow is typically inaccurate. So we want to use different tools. So even though it says 17 there, let's look at somebody that this is what I've been seeing. So we said that house is what, 275, right? So let's go 275. Enter that into our tool. They're gonna put down the 3.5%. Let's just say their interest rate is 6.6. That's what I'm seeing now. 30-year fixed rate. Is gonna compute all this stuff, puts in the tax. There's no HOA. If there is, then we can add that there. Let's let the compute give us a total here. All right, so you can see that might not be affordable for everybody, so it's nice to kind of see this, because it's gonna include the taxes. It's gonna include that MIP that we talked about. It's a FHA loan, and we're putting out less than 20%. Let's just say we put down 20% and see what it does. Yeah, that should probably not be there, but it's a tool. So you see, you put down that it typically, I think they said that the standard is like every 1,000 things, every 1,000 down, bring your payment down like $25. So you'll see it's still pretty high. I mean, 2,000 is not a typical. I mean, maybe if you rent in a higher income area, or if you rent in a like higher income town, it's gonna be a little bit more expensive, but it's pretty high for most people. So what can we do to bring that down? So let's bring it back down to 3.5%, and you don't have that. And let's just kick this interest rate. Let's see if we can bring it down to 5.5. What's your thing is a DJ? Okay, so you see it improved, well, not a whole lot, but it improved from the initial. Well, let's actually see what it's 646 again, just to give you guys a visual. So keep that number in your mind. Okay, so you see that you're saving about almost $200, just because we brought down the interest rate 1 point. So a couple things you can keep in mind. We have tools that you can use to, say, negotiate. Maybe having the seller pay towards your closing cost, which you can apply towards maybe a rate buy down, or maybe you can buy down the rate yourself if you have more money saved up. to use as a down payment or to pay towards that. There's different tools to use to help with that. With this one, that's the kind of payment, with that interest rate. So there's, I would say, maybe even put down a little bit more, or different things. There's different tools. So I just wanted to give you those visuals, because affordability, I think, is very important, and I coach my clients on that. Like affordability, like what is your gross monthly income, divide that by 0.5, and then that can tell you kind of a rough estimate of what you can expect. So that is it. Thank you guys for watching this video. If you like this content, please like and subscribe. And once again, it's your boy Troy. Have a good one.